Welcome to WHV's International Equity Webinar. Today we are going to talk about the energy markets in particular, as well as recap the thesis behind and that underpins the strategy. My name is Scott Blankenship. I am with WHV's sales team. Today I'm joined by Dick Hirayama, PM on the strategy, as well as Allison Goodson, a PM and analyst on the strategy. The purpose the agenda will be twofold. There's going to be some opening remarks from both Dick and Allison to cover some of the dynamics of energy as we see them today, and then we'll simply jump right into questions. To ask a question, you can do so through the chat function on your toolbar through the webinar portal and click submit. So we'll be jumping into questions in about 15 minutes, so please, I encourage you to get in the queue early, and we'll do our best to get to all of your questions today. With that, I will turn it over to Dick Hirayama.
Thank you very much, Scott. Welcome to our December webcast for the International Equity Product for WHV Investments. I have with me Allison Goodson, one of our portfolio managers. Allison, what happened to the energy market?
Thanks, Dick. Well, last Thursday, OPEC held a general meeting at which it decided to maintain its production quota of 30 million barrels per day, much to the surprise of many outside observers and to the dismay of certain OPEC members. As a result, oil prices fell approximately 10%. In deciding not to cut the production quota, we believe that OPEC, and specifically Saudi Arabia, is effectively electing to endure short-term price pain in exchange for maintaining its market share.
Well, OPEC was founded in 1960, but they have only engaged in one price war in 1986 between Saudi Arabia, Kuwait, and others within the OPEC cartel. And during that 86 price war, Saudi Arabia increased production in order to gain market share from other OPEC members. This time around, Saudi Arabia is producing 9.65 million barrels per day out of the 30 million for OPEC and total global supplies of 93 million. But Saudi Arabia is still producing at the same level it was producing last November. And in fact, September of last year, they were producing more at 10 million barrels a day. So Saudi Arabia is not aggressively increasing production, but is just trying to hold its current market share in the current market. So, Allison, why didn't OPEC cut?
Well, first of all, I'd say we cannot be certain of OPEC's strategy. That said, there are some very strong theories. Most attention has focused on the idea that OPEC is trying to force out high-cost U.S. shale. We also wouldn't ignore the possibility that there are larger geopolitical factors at play. And finally, Saudi Arabia has expressed a desire to see other large players, particularly Russia, cut their production. You have to remember that when OPEC members call for OPEC production cuts, most of those most vociferously calling for the cuts are not the ones who would cut themselves. Most of that responsibility would fall on Saudi Arabia's shoulders. And frankly, it doesn't want to take all of the pain of a cut itself.
We believe possibly the Saudis are correcting a mistake they made on their own by allowing the Brent oil price to average $110 a barrel on average for the past 3 years with very little volatility. That encouraged more exploration and drilling by non-OPEC countries such as the United States with its U.S. shale development, Canada with the oil sands, and Brazil with its offshore developments. And with this very high triple-digit price for such a long period of time, U.S. shale production has increased dramatically, as you know, and the lower prices are intended, we believe, to discourage the marginal shale oil and other non-OPEC developments. So, Allison, what do you expect going forward?
Well, we believe that in the near term may continue to be difficult for our energy names, but we continue to maintain conviction in our overweight to energy. Low prices may spur oil demand from consumers, particularly in the U.S., and sovereigns, particularly China, as it increases the pace of filling its strategic petroleum reserves when oil prices decline. The IMF estimates that a 25% fall in oil prices, a little less than we've seen so far, would result in a 0.5% increase in demand globally. That doesn't sound like a lot, but it's not negligible in the global oil markets. In addition, global oil demand is positively correlated with global growth, which we believe is set to accelerate in 2015.
To regress a little bit, in 2013, Saudi Arabia stated that $100 per barrel oil price was fair to both producers and consumers. And in the June OPEC meeting, oil was over $110 a barrel, but they did not even state that that was uncomfortable for them. So what changed? And possibly the one major thing that changed between the June OPEC meeting and the November OPEC meeting is that global real GDP growth has been sliding from 3.8% to 3.3% during 2014, and that has cut oil demand growth in half, from a 1.5% growth that was expected mid-year down to a 0.75% growth. And that 0.75% reduction in oil demand growth impacts oil demand by about 700,000 barrels a day, which accounts for a significant percentage of the current oil market's oversupplies. As far as increasing demand, if you reviewed the U.S. auto sales in November before this recent decline in oil prices, the world is reacting to oil prices in a favorable way for the industry, in that it encourages consumption, encourages driving, encourages consumption of gasoline. Even for U.S. auto sales in November, large SUV sales were up 14%, large pickup truck sales up 14%, compared to small car sales up only 6%. So larger vehicles are already selling at more than double the rate of smaller vehicles in the United States, and these larger vehicles will be around for the next 12 years on average life expectancy. And even the Chinese car market, which is the largest car market, at 23 million unit sales per year compared to the U.S. Car sales of 17 million units. The fastest growing segment of the Chinese car market, even though it is very small, is the SUV market. So globally, as gasoline prices become very, very cheap, it stimulates driving, it stimulates buying bigger cars rather than smaller cars. It will motivate people to buy less electric cars, less hybrids, and utilize less solar, less wind, and use more traditional lower cost oil, natural gas, and fossil fuels. What do you see in summary, Allison?
Well, as you pointed out, global oil demand growth estimates have come down this year. But we need to remember that global demand is still solid and growing. We believe that long-term supply challenges, which together with the demand growth underpin our overweight to energy, will remain as new oil supplies look to be smaller, more complex, and demand more resources, both financial and technological, to develop. Additionally, we expect that the longer that oil prices stay low, the greater the chances that projects necessary to meet future oil supply will not go ahead. So we maintain our conviction in our overweight to the energy sector and believe that the sector offers particularly compelling risk-reward right now.
Well, thank you, Allison. The long-term supply challenges, we have to remember that oil and other natural resources are depleting resources, and the estimates are that the oil depletion rate is 4% per year, meaning that if you start out with 100 barrels of oil on January 1st, you only have 96 barrels at the end of the year because you produce 4 barrels out of 100. And also, oil demand growth climbs 1% per year. So the challenge that the energy industry faces is that they have to replace the 4% of oil that they produce plus add 1% to match demand growth. 5% per year is what the industry has to find in gross barrels. And so if you look at the long term, that means the supply challenges between 2015 to 2020, those 6 years, the energy industry needs to find 30 million barrels per day of new gross supplies. And today's current production is 93 million barrels per day of demand and supply. So the challenge is staggering. Now, as far as if you have the different slides, on slide, just touch on one more slide, 15, the low the Brent price has fallen from a high of 115 to 80 just before the OPEC meeting, and it's dropped below 70 currently. And you can see on slide 15 that 8 of the 13 OPEC members cannot balance their fiscal budgets at $100, and this is missing Venezuela. And Russia is a non-OPEC country. They too need over $100 a barrel to balance their fiscal budgets. So why is that important? It's important because these oil exporting countries spend a lot of money on social and welfare spending so that their unemployed folks don't revolt. And you've seen that in the Arab Spring of 2011, where Tunisia, Egypt, and Libya had multiple revolutions, taking out the previous 3-decade-long dictators, Gaddafi and Mubarak. And so not only are those countries vulnerable, obviously, but Saudi Arabia has a break-even point of $85 a barrel, and so they would be running a fiscal deficit, but they do have $750 billion of foreign exchange reserves or wealth assets, so they can certainly weather the storm for many years. But we don't have Venezuela here, but Venezuela's break-even point is $120 a barrel. They only have 1 year of foreign exchange reserves to offset their fiscal deficits. So there might be unintended consequences by OPEC by keeping this price this low, in that Venezuela could have social unrest or potential revolution. And even in Saudi Arabia, half their population is under 25 years of age. In the 15 to 24 age group, which represents about 1/5 of their population, they have 28% unemployment. So their challenge is to spend a lot of money each year to keep the unemployed youth placated so that they don't gravitate towards extremist philosophies. And other countries such as Nigeria, Iraq, Iran all have these major problems of high youth unemployment, and they continue to spend more and more each year on welfare to prevent social unrest. So over the long term, the Brent price at this current level is unsustainable because many countries will have increased social unrest. Russia as well, it's not an OPEC country, faces major problems with the new economic sanctions, and also their break-even point is over $100 a barrel. But with these low oil prices, Russia will be impacted negatively the most because they have an 8% depletion rate, and they produce 10 million barrels a day. So that means that potentially, if you assume net depletion maybe half of that, of 4%, they will be losing 400,000 barrels a day of net production per year. So that could also help balance the current oil markets. Scott, shall we move on to questions?
Yes, thanks, Dick and Allison, for the overview. We're going to grab a few of the questions here. There's quite a few in the queue. All right, so Dick, there's a persistent question on two things. One, do you think oil is in the 70 range now? Do we think it's going to go lower? And if so, can you define your time period for that? So do you anticipate there to be extended volatility, or have we seen the bottom yet?
Well, Scott, we have never forecasted the oil price or any natural resource price. It's very difficult. But what I can say is that at these prices, shale development is going to slow down. Bloomberg said yesterday that the oil price for the Bakken in North Dakota is now down to 50 because that is a very prolific area, but the oil is so prolific and they can't move it out fast enough. So that's even lower than the current West Texas price. So the shale developers are going to cut back on their capital expenditures. And I think that's one of the reasons why the Saudis took this action, is that because the Saudis kept the price at triple digits for so long, 3 years, the U.S. exploration production industry as well as U.S. super major energy companies outspent their cash flow. And in fact, the U.S. E&P companies spent 140% of their cash flow on new investments. And many companies had to borrow from the bank to compensate for the extra 40% that they overspent. And I think the Saudis wanted the U.S. E&P industry to cut back on all this excess spending, which has led to a lot of new production.
Great, thank you. Staying on that same theme, there's a question in that asks what the production in the U.S. shale markets is going to be into next year and beyond.
Would you like to answer that, Allison?
Sure. I mean, as you just alluded to, we expect to see E&P companies cut their CapEx. We've already seen some of them start to do so. And as a result, that will have an impact on production growth within the United States. An estimated 75 to 80% of CapEx spending in U.S. shale is essentially spending just to keep production levels flat. So when you see CapEx cut, you see the growth cut disproportionately so. That said, the impact isn't immediate. There are factors that can allow companies to continue producing, whether they be hedged production or wells that have been drilled and not yet completed. So we don't expect an immediate decrease in production, but certainly with prices where they are, we're seeing the foundations for slower growth in shale.
Thank you. Before we move on to the next question, a very important point that I did not cover is that since the oil supplies will continue at their current pace, the only way to correct the imbalance is to increase demand, and that is comes from higher global GDP growth, which the IMF expects to increase from 3.3% this year to 3.85% next year, and that should increase global oil demand, which would satisfy Saudi Arabia's issues. And where would that come from? Well, if we look at the regions of the world, Japan was in a recession in the third quarter, so they're going to improve, and the government has delayed the second consumption tax hike, and they also engaged in another round of quantitative easing or money printing. So Japan should recover from their near-term recession. The Eurozone is growing at only 0.5% with 0.5% inflation. So the Eurozone is faced with a double whammy. They're very close to recession. They're very close to deflation. So it seems that the European Central Bank will be forced to engage in their first quantitative easing program during the first half of next year, which should stimulate their region. China, as you know, has been slowing down from 7.7% in 2013 to most recently 7.3%. However, the government appears to feel that the economy is slipping below their target, and so for the first time in 2 years, the People's Bank of China cut interest rates first time since 2012, and also the Shanghai stock market has been rising sharply, and possibly Chinese investors are anticipating a second interest rate cut for China, so that should support China's growth next year. Also, lower oil prices are a benefit to both the emerging markets and to the developed markets. And for the United States, growing at 3.9%, it's going to help retail sales because lower gas energy costs will increase disposable incomes, and there's more income available for other spending.
Great, thank you for that. So there's a lot of questions related to Saudi Arabia, obviously, as they have kind of carried the stick, as you, if you will, with regards to OPEC. How does the decision last week affect the relations between Saudi Arabia and the United States?
Well, I think if we look, I think the Saudis are currently very short-term oriented because I believe they forgot that we saved them from Saddam Hussein in 1990 when Saddam invaded Kuwait, and his next stop might have been Saudi Arabia, and so we saved Saudi Arabia from a very difficult situation there. And so, and also we are still a major importer of oil, and we are a customer of Saudi Arabia. So it doesn't make sense for the Saudis to engage in an aggressive price war with the United States because they need us, especially the Saudis' mortal enemy, Iran, is on their eastern flank, and so they need us to protect themselves from an Iranian invasion or an Iranian nuclear attack, and so they do need our economic and also military power to protect them from their potential enemies, and they have enemies all over the place. Now the Saudis have the potentially nuclear Iran on their eastern flank. They have in the south a new Shiite group has taken over the capital of Yemen, the southern border of Saudi Arabia, which is the other Muslim religious sect that's along with Iran. And as you know, Yemen is also the home of the Al-Qaeda of the Arab Peninsula, and in the north they have Iraq, and also, of course, as you know, ISIS is in northern Iraq. So basically the Saudis are surrounded by volatile or potentially enemies, and so they have to not only ramp up their social spending and welfare spending to placate the unemployed youth, but they also have to increase their defense spending so that they can protect their sovereign wealth and people.
Great, thank you. Let's pivot a little bit. There's a lot of questions related to the portfolio as a whole as it relates to the super cycle. So I think I've got about 30 questions in the queue specifically asking about the super cycle and what your view is of it today.
Well, we feel that the super cycle is intact because the emerging markets, as we thought since 2000, would continue to outgrow the developed markets. The developed markets are too high cost, and that's why You see Japan in a recession, the Eurozone growing at 0.5. The only economy that's growing at a decent rate is ours at 3.9, but really 4% is an optimal level, and anything under 4% is suboptimal, and primarily the developed markets are growing slower because basically we're too high cost, and we're also laden with quite a bit of debt. So the emerging markets will continue to grow at a faster rate, although it has been sliding down. Still, it's still going to be at a premium growth rate, and you have 6 billion of the 7 billion people on the planet in the EM, and they are industrializing, urbanizing, and the population of the world is going to expand by 2 billion by 2040, and that's going to increase demand for steel and oil and other natural resources to build buildings, infrastructure, etc. So this is a long-term secular trend that we continue to favor to be invested in.
Fantastic. Speaking of long-term, there's a series of questions asking specifically for you to define your vision of long-term and how that relates to the portfolio.
Well, the long-term, if we examine the growth of, let's say, Japan during their first industrialization phase, it lasted from 1945 to 1989, or 44 years. South Korea's first industrialization phase from 1953 to 1989, to 1997. So in both Japan and South Korea's cases, their first industrialization phases lasted 44 years. China is 36 years into their industrialization, so they can continue to grow for many more years, assuming that they're following the footsteps of Japan and South Korea. But China is more favored because Japan is a bunch of islands with 100+ million people. South Korea is a half a peninsula with 50 million people. China has 1.36 billion people, and it's a large country geographically, so they are more like the United States, but with 4 times the population of the United States. And so they're going to end up, they currently have their car market is 23 million units a year, and projections are that by the end of the decade, their new car sales will be 31 million units per year, compared to currently our market of 17 million auto units per year. So these trends can last a long time, and India is 20 years behind China with another 1.3 billion people. So this is truly a secular trend, and they are industrializing and urbanizing, modernizing their infrastructure, which requires a lot of energy and natural resources.
Great, thank you. Next question has to deal with similarities that you're seeing today. Does what you're seeing today with the pressure on energy relate to any period in the past that you can relate, given the strategy?
Well, we endured the Great Recession, and there the oil price dropped all the way down to $32 a barrel. And so we stuck to our philosophy then, and it proved to be the correct strategy not to sell out at the bottom. And in 2009, 2010, our portfolios recovered. So we go through these volatile times, and I think that the Saudis wanted volatility now because they made the mistake of keeping the oil markets non-volatile over the past 3 years, which encouraged U.S. shale drilling, and also they maintained a triple-digit price, which compounded that issue.
I would also jump in and say that clearly the macroeconomic environment is very different now than it was during the global financial crisis, but as Dick just said, the opportunities that we see within the sectors that we invest in, we see parallels between the two times.
Also, I might interject, let's say the global economy continues to be sluggish with tepid growth and not attain growth that's closer to 4%, and repeat in 2015 what occurred in 2014, suboptimal growth of only 3.3%. In that case, I would expect that all the major central banks of the developed markets would engage in quantitative easing or some other kind of monetary accommodation measures that would push the inflation rate up, because that's one of the major problems that we have in the developed markets, is that the inflation rate is too low. Ours is 1.2%. Japan is trying to push it up from deflation up to 2%, and the Eurozone is 0.5. And I think that with increased weakness in the respective economies, those central bankers will print more money in order to create more inflation, and potentially if we are at the rock bottom of inflation, then once inflation starts to turn up a little bit, then global investors might think about shifting a small portion of their assets towards inflation hedge type investments, and energy, materials, industrials tend to be more inflation hedge oriented than the benchmark.
Thank you. This next question is more portfolio specific. Do you foresee any of the names that you currently hold possibly having to cut any of their dividends?
Allison?
So I think we can't completely rule out the possibility of that happening, as we cannot necessarily say how long commodity prices will stay low at this point in time. Yet we have looked at our companies where we feel there's the most risk, and we feel that at the time, for the time being, the dividend of these companies is intact. I think there's certain sectors, for instance, the offshore drillers, that have been experiencing a difficult a down cycle for longer than the say the larger oil services companies have. And we have recently seen some dividend cuts in the offshore drilling group. We own what we believe are the best in class of the offshore drillers, and one of the reasons we think that they're best in class is we believe that their dividends are safer than those of others, due to their more secure cash flows, better balance sheets, etc. So I would say we feel confident, but we can't rule out the possibility that that could happen depending on how long commodity prices remain under pressure.
Thank you. This next question is China specific. Obviously, we focus on China. This question asks if you trust the GDP numbers that are being published from China, forward-looking that is.
Well, since China releases their own numbers, those numbers can be manipulated, but I think that if they're overstating their economic numbers and understating their unemployment figures, they will engage in stimulative monetary and fiscal policies so that it would maintain their growth track, because they too have to worry about revolution. They've seen it in the former Soviet Union, Eastern Europe in '89 and '91. They've seen it in the Arab Spring in 2011. They've seen it in Ukraine in February of this year. So they too realize that they are vulnerable to a second people's revolution. And so I think that with $4 trillion in foreign exchange reserves, one of the strongest currencies in the world, is one of the few currencies over the past 5 years that has advanced relative to the US dollar. And the government owns or controls most of the state-owned enterprises, which happen to be the largest corporations, and they also own the largest banks in China that the government can engage in enough stimulus to keep China on its growth path so that it doesn't create too much unemployment. Their primary goal is to preserve social stability, and so I think that they have the financial resources, and they don't have to print money, they don't have to borrow money. That is the federal government. They are well endowed, and also the federal government owns a lot of huge corporations such as PetroChina and so forth, so that they can sell assets, but down the road. But with $4 trillion, they can do a lot of good for their country.
I would also just jump into the question of the Chinese GDP numbers. I think part of the reason that people have come to question those is the sort of infamous comment from the current premier that was leaked via WikiLeaks a few years ago that suggested that GDP numbers were for reference only, and what he preferred to use was sort of an amalgamation of metrics that are less easily manipulated, such as freight volumes, loan growth, and power consumption. And so as a result, people tend to track those, and they've dubbed it, forgive me if I butcher the pronunciation, but the Li Keqiang index. And so essentially that verifies the numbers that the government produces, and certainly the directionality, and I think that's what's most important.
I think we have to realize that China is more up-to-date and modern than we think, because although the federal government has more or less controlled Google and Twitter, they do have a Weibo system, which is similar to the 140-character Twitter. So people can basically Weibo, or Chinese Twitter, their complaints, and it can reach millions of people. And in fact, individuals have Weiboed Chinese ministers, and the federal minister replies within a day, because he knows that Weibo has reached millions of people. So social media is something that has taken down quite a few governments, the Ukrainian government, maybe a lot of the Arab Spring governments in North Africa, and so they can do the same thing in China. People can organize in China quite well with Weibo, and so I'm sure the federal government realizes that the people have a lot of ability to organize, demonstrate, and therefore I think the Chinese government will do anything to maintain a job creation and keep the unemployment level low.
Thank you. This question back on China again. Is there anything that you look at or you view that is a leading indicator for China, and maybe specific to the rest of the emerging markets?
Well, Allison, you just touched on that, the Li indicator.
Certainly, we look at a variety of metrics in order to gauge what we expect to see as the demand for the commodities to which we're most exposed. Certainly China is an incredibly important player in the global oil markets, but it is by far the largest player in the iron ore markets. So, and that also is where we have the most direct exposure through our iron ore exposure to China. So there in terms of looking at leading indicators for iron ore, the property market in particular is particularly important. Certainly it's gone through a difficult period, particularly earlier this year. So we look at leading indicators like land sales and floor space under construction, which tend to be fairly solid leading indicators of demand growth for the materials that go into building. And we've seen those recently tick up a bit, which is very positive after, as I mentioned, after a somewhat challenging time earlier this year.
Great, thanks. Back to energy specifically. So Saudi Arabia, kind of the OPEC leader. This question is specific to crude oil and how Saudi Arabia is able to influence such as the question asker puts, undifferentiated commodity in oil. Since the U.S. has oil's everywhere. How is Saudi Arabia able to control that?
Yeah, so I'll frame it a little bit, frame the question a little larger, because really the question is, how does OPEC control it? And then you drill down a bit and you realize that it's really Saudi Arabia that's the most important player. Part of the reason that they're able to have such outsized influence on the oil markets, beyond the fact that they are that OPEC holds the vast majority of the world's oil reserves, is the fact that because they have formed this cartel-like organization, they tend to match supply with demand. And so OPEC is the only real source of spare capacity in the global oil system. Anyone else in the system has the economic incentive to produce as much as possible all the time. Because OPEC maintains spare capacity, it's able to adjust its supply and therefore have an outsized influence on prices. Now, Saudi Arabia within OPEC maintains the vast majority of the OPEC spare capacity. So when you talk about spare capacity in OPEC, you're really talking about spare capacity in Saudi Arabia. So that, coupled with just the size of their reserves and the amount of their volumes, gives them the outsized voice that they have in the global oil markets.
Well, if we look at the OPEC's actions over the past 2 years, their gross production has been relatively flat for the past 2 years in barrel terms, but the demand for oil has advanced during those 2 years. So the market share increment that OPEC did not gain went to non-OPEC suppliers, primarily the United States with their shale. So OPEC continued to produce 31 million barrels a day plus or minus 1, and any incremental growth from global oil demand has been ceded to the United States. And the problem is that for the Saudis, the increase in U.S. shale and other non-OPEC supplies is now exceeding the growth in demand for oil, and the Saudis do not want to reduce production currently. But market forces should eventually rebalance the markets by increasing demand and over the next several years reducing the growth rate of U.S. shale development.
Well, great. Thank you. That wraps up the questions that were in the queue. Dick and Allison, I'd like to thank you for taking time today to do this impromptu mid-quarter webinar. And I'd like to thank everyone who dialed in. We appreciate your interest, and we look to catch you sometime early next year for a formal quarterly update. Now, before we sign off here, I need to read these important disclosures to make everyone aware that the information provided in this webinar and any communication or transcript related to this webinar are as of the date of the initial publication and are for informational purposes only and may not be recorded, reproduced, redirected, or distributed without prior written permission of WHV. Nothing presented in this webinar is intended to constitute investment advice, and no investment decision should be made based on the information provided. Information provided reflects the views of WHV as of the date of this webinar. Such views are subject to change without notice, and any information regarding holdings, allocations, and other characteristics are for illustrative purposes only and may not be representative of any current or future investments or allocations. This information is not a recommendation to purchase or sell a security or follow any strategy or allocation. Any forward-looking statements or forecasts are based on assumptions, and actual results may vary from any statements or forecasts. While WHV has used reasonable efforts to obtain information from reliable sources, no representation or warranties are made as to the accuracy, reliability, or completeness of third-party information presented in this webinar. It is possible to lose money by investing in securities. Past performance does not guarantee future results. Thank you once again, and everyone have a happy holidays.